Please welcome the panel on New Realities in Asset Management, moderated by Asset Management Editor at the Financial Times, Harriet Agnew.
It's bouncy. Good afternoon, everyone, and thanks for joining us for the last session of today. I'm Harriet Agnew, Asset Management Editor at the Financial Times, and I'm delighted to be here with you all. It's a challenging time to be an asset manager. Tailwinds have become headwinds with higher interest rates, higher inflation, and deglobalization. The geopolitical landscape is becoming more fragmented. Rapid developments in technology are reshaping the way that firms invest and interact with their clients. And there's a climate imperative to fund the energy transition. With all of this in mind, we bring you a mixture of perspectives from our panelists, representing a hedge fund, a traditional asset manager, and two big pension funds. So I'd like to introduce them all to you. Terry Burgess is head of investment boutiques at Wellington, which is one of the world's largest privately held asset managers. Scott Chan is Deputy Chief Investment Officer at CalSTRS, the second largest public pension fund in the US. Jonathan Hausman is responsible for strategy development and implementation at Ontario Teachers, which is a pioneer of the modern public pension model. And Joanna Welsh constructs and oversees risk management at Citadel, which is the world's best performing hedge fund of all time. I'd like to start by asking all of you in turn, how do you, when we think of innovation, how do you set yourself apart from your peers and create an edge? Why don't you start?
Well, I think the edge at Wellington are a fewfold. One is, I think we have, we have a private partnership that's independent. Each one of those three things on its own is pretty interesting and powerful. But when you combine the three, it allows us to control our own destiny, use our own balance sheet, and stay really long term in terms of that innovative spirit and what we're doing for clients. I think the second thing we do is create a global conversation that's not easy to replicate. So firm started 100 years ago with 4 people around a table, and now it's 600 people around a global table exchanging ideas, debating amongst all asset classes, all different factors affecting the global economy. And I guess the third thing is we're very client-centric, which I know most are, but we really try to draw from our clients in terms of what solutions they're trying to solve, and particularly look for things that we call adjacencies that plug into something we already do quite well that we think we can expand, and so that solves a problem for them. It diversifies our business, and it strengthens our whole investment ecosystem.
Thank you.
You're welcome.
Scott.
Oh, great. Yes. So, at CalSTRS, we've thought deeply about the competitive landscape because for us, it's really evolved. And so over the last 6 years, we created what we call the collaborative model, which is our way of trying to bring more of our assets in-house. We do that really successfully in the public markets, where we're mainly sort of passive or slightly enhanced. And we've shifted a lot of the risk to the private markets. And so in that way, we try to become the global partner of choice and really be innovative around how we structure our partnerships, whether it be owning the asset manager, having minority ownership, doing rev shares, doing co-invest or SMAs. And I think that really helps to differentiate us. One of the difficulties we have is we compete against folks like ATPP, and so we're a state or government agency. We have a lot of constraints on regulation, and particularly around resources, how we can compensate folks. And so for us, it's really about becoming the best partner, and hopefully then we can access the best transactions. So our effort is really wrapped around trying to make this a true partnership and be a two-way street.
Jonathan, just building on that,
Sure.
What were some of the pillars in the way that ATPP was constructed and has kind of paved the way to allow you to invest the way that you do today?
Yeah, so Ontario Teachers started in 1990 in its current form. And people look back on the history of the fund, and I think they construct a story that is very logical, and it all fits together. But much of Teachers, like many things in life, was created by necessity and by a confluence of people and places and individual personalities. So really, this was a time in Ontario's history where we had a very, very poor fiscal condition, and the government was absolutely keen to get this particular obligation off the balance sheet and into a corporate structure, and that was by necessity. But what really the personalities came into play with really two people, our first president and our first chair. And they said, look, if you're going to do this, you got to do it right. We need to have delegated authority to the experts, and we need to have a governance system that is going to remain completely unpoliticized. And in that way, they created a pathway for this organization to do three things that I think are really very important, three pillars. The first is innovation. Strangely, the first asset and the only asset the fund had was a bunch of debentures from the government of Ontario that couldn't be traded. So, mother of invention, necessity, we had to start to figure out how to use derivatives to get a more diversified portfolio. And so we were one of the first players really in our space to use derivatives in a very big way. The second is we started to realize that we needed to have execution teams in a number of different domains. So private equity, infrastructure, natural resources, and of course, real estate, where we purchased a large real estate operator, developer, and manager in 2000 called Cadillac Fairview, which we still own today. And then finally, really was a question of being global. This was an organization that realized that Canada is a great place, but we have to have, according to portfolio theory, a globally diversified portfolio. We started to build our offices first in London and then in Hong Kong, and now 8 offices around the world to try to maximize that diversification further.
Thank you. Joanna, would you like to talk a bit about how and where Citadel is innovating?
Sure. I think I'm actually going to go back to your first question, if I may, just to kind of tee it up. And you know, you asked about how each of our organizations set themselves apart and creates an edge. Because without those two things, you can be as innovative as you want, spinning lots of things up, but a foundation of success is really important. So, you know, Citadel, as you were kind enough to point out at the intro, was named the most successful hedge fund of all time by LCH. And that's not something that happens overnight. It's like any investment, we've reaped the benefits of 33 years of compounding in our returns and investing in businesses, investing in people, you know, but also I think equally as important that because there's a lot of discussion these days about hedge fund returns, multi-strat returns, it's important to point out that the returns of Citadel, well, the returns of the multi-strategy space would be about 40% worse if Citadel wasn't in it. So you know, we really, we pull our weight, so to speak. And both of those things, they're a reflection of, you know, what we think is real strength and depth in our business. And one of our main edges, and one of the things that's very differentiating for us in the hedge fund space, is that we're IG rated. We've been IG rated for the last 20 years, and that reflects not just superior return generation, but strength throughout your whole business. And I think, you know, that's one of the things that we'll touch on later when we start to talk about how we innovate, how we stay ahead, how we deal with competition, but I'll leave it there for now.
Thank you. And just to build on that a little bit more, how does Citadel's culture play a role in its success in terms of things like collaboration?
So look, there's 3 things I think we do really well. Risk-taking is our core competency. We're risk takers. We know how to collaborate successfully and build great teams. And alpha decays over time. Everybody knows this. So you have to keep innovating. But you can't stand still. But I think one of the things over the years I've been at Citadel that I've really noticed and has really impressed itself upon me has actually been our goal-setting process, which I think is quite innovative. Ken is personally involved in the whole thing with each of the business leaders. And really the goal of that goal-setting process is to raise aspirations. That's what it's there to do. It's not there to hand out tasks or to make a list. When we said we want to be the best investment firm, that's an aspirational goal. And when you turn your people to dealing with things that are very aspirational, they can't do that if a big part of their brain is on let's call them low-value tasks. So another big goal of ours is, and I'm going to borrow this from our co-CIO here, is to eliminate work that doesn't build great careers. And if you have a goal-setting process, which is about raising aspirations, and you have a commitment to eliminating work that doesn't build world-class careers, I think you've built a very kind of fertile ground for lots of different types of innovation.
Terry, how do you incorporate innovation into your goal-setting process?
Yeah, it's a very big part of it. So we start with, we do a few things. I say one is, as I mentioned before, we really listen to clients, and we try to set a goal with different clients in terms of solving the needs that they have. Each business leader is given, we call it invest and measure. So each business leader is given partner capital at the firm. So there's client capital, which is obviously comes with the highest amount of pressure. But partner capital is right behind that when you're investing the capital of your colleagues. And that's given to each of the individual leaders to allocate in their lines. So I look after our long-only business, which is equity and fixed income, roughly a $900 billion business. And then I am given an amount of capital to allocate to those that I think are the better strategies that I'm seeing bubble up from some of our incubation processes, and those that I think are the better investors that I'm starting to see develop. And then I am measured on how good I am at that ROI, the return on that investment. So I think it's making sure that you're setting goals with clients that you think you can attain. I think it's that invest in measure piece. And I think the last part of it is experiment and scale. And so one of the things that we see in a lot of different asset managers is they go after something that's pretty big, and they sort of build it in a siloed fashion. I think in recent past, I would say big data, investment science, people call it all different things, was probably one of those areas where you built it to a multi-million-dollar type of effort for a specific firm. And you found that once you had built it, it didn't really, the language between the fundamental investors and the investment scientists was one that just didn't lead to a lot of efficacy. And so rather than do that, we do a lot of little things and we embed those in the teams that we have. So we take our investment scientists, for example, our data scientists, we put them on fundamental teams. We figure out what's working on that team, and then we scale that up for the rest of the organization. And we figure out what's not working, and frankly, we leave that on the cutting room floor. So that's how the goals work in for each functional line manager to sort of operate within those parameters.
Mm-hmm. Thank you. And Joanna, perhaps you might want to take this one as well, but how do you get in front of developments that you think are going to be meaningful rather than sort of reacting to what you see elsewhere? How do you stay ahead?
Yeah. So I think it probably bears mentioning that the environment in which we are investing is vastly different than it was even 5 years ago. It's impossible to answer your question without saying that we are in the midst of, and I think it's become palpable to most people, in the midst of sort of simultaneous paradigm shifts taking place in key things to investors. People talk a lot about the geopolitics, but equally the climatological, the technological, and I would argue also a financial paradigm shift, which is not quite as exotic, but it's certainly rather important. And so when you're faced with these kinds of transformations, I think the way that we think about investing, the mindset that we bring to investing needs to be much more critical of the underlying assumptions that we think we have about the business that we do and the environment we do it in. And so I would say that we've tried to be very purposeful about questioning some of those assumptions, and been doing this for a few years, and trying to do so as part of an approach to investing which doesn't put so much emphasis on getting the right answer. It's really more about what kind of organization do we have? Is it capable of pivoting to opportunity? Because we do not know what the future will bring. People like to think they do, but they don't. The second thing is, it's also important to preserve the organization's capacity to keep its head, if you will. And so that composure comes from what we call preparing. Preparing is not a thing that a lot of people in finance do. We tend to act, right? But preparing is important. And the other sort of article of faith of the way we think about the environment is that these simultaneous paradigmatic shifts also produce shocks. We've had two 1 in 100 year shocks in 3 years. So you can be blown over by those, or you can try to think through, well, what does an organization do if X or Y or Z were to occur? And we've actually gone through a process of trying to lay out what we think those shocks would be that would be most impactful to Ontario teachers. Now, I have to tell you right away, one, we may not have the right ones. Two, we also they may never happen. But it's the process of developing that musculature in the organization that builds that ability to anticipate. And I think there's a much greater premium on that today than there was before, because the premium is not on getting the right answer and saying, oh, well, rates are going down here, so I'm going to put this on. No, it's about if a certain set of opportunities arise, can we pivot? Do we have the conviction, or are we still running around with our hair on fire because something happened that we didn't expect?
And so in this environment of much more uncertainty, Scott, what does it mean for active management?
Yeah, I mean, I think branching off of some things Jonathan said, I think one of the things that we're really seeing is a rise in systemic risks, right? So if you think about climate change, the energy transition, even what's going on from a lot of the societal concerns, the sort of the divide between the rich and poor and the labor issues, these are hard for you to inoculate your portfolio on. And so I think what we're trying to do, and I think Jonathan also mentioned the paradigm shift with interest rates, inflation, all these what had been tailwinds, low interest rates, low inflation, globalization, are now headwinds, right? So what we've tried to do at CalSTRS is just try to build a more flexible, adaptable approach. And maybe in three ways. Number one is, for the last decade, we built out private markets and our alternative assets portfolio. And so we're, call it 42, 43% in that. And now that we've built it out and fairly diversified the portfolio, that, by the way, was the reason for our strong
Scott,
returns.
when you say diversify, what do you mean? So here there's various ways you can get diversification. So you can say like now we've maybe had to think about changing our investment horizon, or when we think about diversification, we think about things that are 1 to 2 standard deviations diversified or diversified in the tail.
We were, I'm speaking more from an asset allocation perspective. We were diversifying from public to private markets over time, and for us, it took, a significant build out because we were executing it, transaction by transaction. So, just even in the last, call it 5 or 6 years, we pushed, call it $50 billion of our portfolio from publics to privates. And now that that's been sort of built out, I guess the point I'm trying to make is we're at this next stage where it's more about where is an incremental dollar of capital going at CalSTRS and competing across the portfolio. And in today's marketplace, I think that having that more dynamic approach, for example, we've been moving more into fixed income and drawing some from hedge funds after several decades doing the reverse of that, right? Moving out of fixed income and going into hedge fund portfolios. So having a dynamic approach to the asset allocation, having a flexible approach amongst the different ways we can allocate our asset classes. We're, to some degree, we've had to organize it ourselves around expertise, right? So we've got a team for private equity, a team for real estate, all the different types of assets that we might invest in. And there are a lot of things that we still don't capture, right? And particularly areas that go across the spectrum where we could actually create more value. So on the one hand, for example, we had our real estate team originating private debt, and then it's getting securitized, and some of it's being kept in private debt, some of it's being offloaded, and our public fixed income team is buying it, right? So why not create the whole chain so that we can capture that value? And so what we did was we helped to launch a manager to do that for us, and we found that we're not only capturing more value in that chain, but we're actually learning so much more and understanding the risk better. What do we want to keep in our private markets? What do we want to offload to the public markets? What do we then want to keep in our public market portfolio?
And you got that by looking across?
We got that by looking across, and so...
Terry, is that the same for you? It's because I know, like at Citadel, this is the bread and butter for me and my job, and it's actually interesting to me when I speak to other multi-strat CROs, and for them, I think this is where our edge in collaboration comes out. And really what it means is that there's many multi-strats out there who, for example, don't prioritize having a firm-wide risk number. They think we have an equity business, we have a fixed income business, we have a commodity business. There's just not that many people in the firm who are perhaps interested in what happens when you put it all together. At Citadel, we care a lot, and I think one of the reasons we care a lot is we did a lot of work in thinking not just about the risk of one particular path, some paths associated with Russia, Ukraine, or things that happen in the Middle East, but to spend a lot of time really deeply thinking about what systemic risks look like and where they will pop up. What's the DNA of these things? What's the catalyst for them? Where will they pop up in your portfolio? And in what order? Is it going to start with, look, if everyone's making money, where's the catalyst for a systematic shock? But if there's a sudden equity drawdown, how do people think about fixed income RV? So like for us, that's where we're looking across. I don't know if that's the same way you guys think about it.
Yeah, it's the same way that's the same way we think about it. We certainly look at, at a micro level, we look at a lot of things. We look at how our strategies are doing on an alpha correlation basis. So we do measure that often and try to figure out if this, we've built our organization to be what we call a federation of boutiques, all doing something different, all doing something that's uncorrelated. And if that starts to break down, we try to figure out why. We try to figure out what are the themes in the portfolios that are popping up and try to figure out a way to break the correlation that wasn't intended to persist through that model. So one is looking at the alpha correlation. The second is really trying to do some of what you said, which is looking at our portfolios. Most of our portfolio managers build it from the bottom up, looking at it from the top down. This is where we think your exposures are, doing a lot of shock scenario analysis. This is where we think you are pretty well diversified. But even though you've built it, I'm thinking of a contrarian portfolio manager who built a 60 stock portfolio that was entirely a bet on rates and oil, because those are the two parts of the market that sold off. And so we say, you really have two bets in this portfolio, so let's make sure that you're diversifying it in a way that you think makes sense for your clients. And then as a firm, we think about what are things that are uncorrelated to one another. And so I talked earlier about the scale of the organization. It's all built around our central research, but in the public markets, what we've been doing for the longest, but we have bolted onto that a private equity franchise that really leverages that deep research, and a hedge fund franchise that leverages it as well. And you get diversifying elements of both, right? You in a more market neutral sense. On the hedge fund side, you start to lower the overall beta of the firm and our ability to invest for the long term. On the private side, that's still tied to markets, obviously, but you get a duration effect that we're not used to with some of our public clients.
So one thing that I do think is important, I'd actually like to ask you, but is not channeling the past through our business models. We can disagree as to how much is fundamentally changing, but we can say that perhaps correlations are changing, perhaps the relationships between different assets are changing. Then what do we do with things like VAR? Are we merely channeling the history, or how do we adapt, I guess, to a stochastic scenario? That to me is one of the big risks in the financial system.
A short-term history, especially if you're in a period of the market where you've had a strong trend. So, for example, in 2023, VAR was not particularly helpful. It's some days maybe you find a day in certain bits of the portfolio where you didn't lose money, or the whole thing was positive. That would be an extreme example. But I really do believe in the value of history, and I've gone both ways. I've gone back and forth on this. I think it depends on the market. Where is it valuable? And this is what I was talking about right when I was referring to scenario analysis earlier. Someone like me, we could spend our time looking at every single way in which a portfolio manager could lose money. That's not my job. That's their job. But a lot of people conflate risk management with that. What we think is far more valuable is to look at the truly systemic shocks, ones which went rippled across many financial markets. And same as you look at economic shocks, you'll often find the same fingerprints there. Maybe there was an oil shock. That's one that's pretty common, for example. But if you go back in history, and whether it's looking at what happened to LTCM, or any LTCM is a great one because it just encapsulates so many of the things that people forget about, the basics. The size of your portfolio in terms of market value matters. You know, the L in long term, which is if you wait long enough, all of these RV things will be fine. Well, one of the first things that happens in these shocks is that the people who are lending you money become very impatient, and the market is only as patient as its least patient provider of leverage and capital. And in terms of the number of those things that have happened in the world, there's not too many. You don't need to go and look at 100 scenarios. There's 4 or 5 that if you really truly understand them, understand how they start, how they progress, how they recover, what the risk factors are, if they were a long time ago. And look, this is hard work. Going back to get data on corporate bond spreads 25 years ago it's a right old slog, to be honest. But what you get in return in terms of understanding these things and understanding crises like them, a lot of post-COVID followed the same path. It's really worth it.
Joanna, just to expand upon that point of data, can you talk a little bit about the work that you've done at Citadel in kind of data labeling?
So yeah, I think this is, again, it goes back to like, what's our mission? So the mission of my team is we're there to quantify the risk, but we're there to explain what's going on in the portfolio, and in a very natural, intuitive way. And if you are, for example, aggregating across commodity portfolios, and it's future A, future B, future C, there's no intuition about that. But if you alternatively try and find a risk vendor who will tell you, who will group this for you, this is summer, this is winter. European and the US, their summers and winters start at slightly different times. Do I want to see things in physical units? Do I want to see things in units of energy? All the things that enable us to have the same conversation as the risk takers are having. It was something that we embarked upon because once we have a comprehensive data model, what we found was that there were just so many different. It gave us a number of ways, incremental ways, to look at the portfolio and to actually be able to say many things in here, but like, what's the trade? What are we really betting on? And it's something that there's no vendor that can do it across as many businesses as we have in Citadel, and so that was why we decided to make it ourselves.
I should have mentioned at the start, if anyone from the audience has got a question, please use the QR code and we can take them throughout the.
But no, I think the data thing is great. It's one of those things that technology, I'm sure, if you think about when you started your career, the role of technology and where it is now, and how you're asked to think about how much you're spending on compute, data, your attitude to data, what people mean when they talk about having a data strategy. It is everyone talks about it, but it means different things to different people. And I think if you don't have a strategy, and there's a question later on about competition. If you're a new hedge fund starting out, I think this is probably one of the biggest barriers to entry.
I agree.
Because at Citadel, how much do you invest per year on technology, do you think?
A lot.
Yeah.
No, but here's the thing: we don't just. But we're investors. We're not spenders. I think. Look, if maybe we'll try and get everyone out here at 10:02 so they can all run off and see Elon Musk. But cloud compute and all of these other things are probably second only to having a space program in how much you could spend if you did it in a not sensible way. If you're not thinking about how does what we're doing make us more productive. So maybe. What do you think about that, John?
I agree. I think that it's all the more important, particularly as more of a private investor than a public investor with Ontario Teachers is, the premium today on having digitized data structured in a manner that can be leveraged by AI-based technologies, I think has gone asymptotic, I should say. And I think that, when we think about the 130 companies that we own, one of the primary things we're saying is let's track the data, let's digitize the data, because that is the lifeblood of companies who wish to be among the winners rather than the losers, because that is going to be the key feedstock to any application of artificial intelligence. And I think that weirdly, whereas everybody, I think you mentioned this, every survey I've seen among both investors and corporates shows the same two results. 90% of corporate leaders think that Gen AI is core to their business, critical to their future, and 90% haven't done anything about it. And so, I think there's a moment here, and nobody knows, and I certainly don't consider myself to be an intense expert on this, but what I would say is that every smart person I've spoken to who seems to be in a position to know says we've basically got 18 months to 2 years, while all the various folks who are trying to figure out how to apply this thing and not, do parlor games and pass the sommelier exam with their chatbots, when they're actually applying it to their businesses, that they're in the bunker, and then it's going to be open warfare in 2 years. So we need to prepare these companies and prepare the cultures inside these companies to be ready for two things. One, use the data, leverage the data, but two, create a culture where people are willing to understand that in every individual person in that company, no matter what level, is not going to be running one process, they're going to be running 100 processes, because that's what this technology allows you to do. So I think there's a lot of premium on putting the data first and letting the organization begin to marinate a little bit in the possibilities.
And Jonathan, are you at a stage yet of using AI to enhance your approach to investing?
Yes, early stage. I don't want to overstate it. I think there's a lot of triumphalism about companies saying they're doing this and that, and maybe they're writing a thank you letter. What I would say is that we've tried to take a very deliberate approach, one which is not about the application, but about the culture of innovation. So it's about putting the tools in the hands of the folks. So we have Copilot for everyone. I think we're among the more early adopters in that regard. And we're encouraging across not just the investments division, but also the other partners in our organization that help us do our job to identify use cases, get them funded. If we need advisors, get them. And again, we feel like we've got like a 2-year runway here to create the tooling, the foundation, the guardrails, because this is not without risk. Let's just be absolutely clear about that. And ultimately, the cultural mindset to be able to move to a different kind of operation.
And so if these technological developments are happening sort of quicker and quicker with every generation, how do you stay ahead of that? Why don't you take that? No,
Oh, me? Okay.
Yeah.
Yeah, I would say it's quite a dilemma for CalSTRS, because I think technological innovation is happening on a bigger scale and faster, right? So it's bigger in the sense that it used to affect companies and sectors, and now it's whole economies. And it's faster. I'm always struck by the stats in COVID, how the internet usage went up, doubled during that time frame. You fast forward to the blockchain, within a year, you're looking at ChatGPT within months, right? So the adoption phase is really fast, and we discussed some of this, but it's faster than regulation, right? So you have to figure out how to regulate yourself. It's faster than talent, right? So we have talent shortages. How can we get the people involved in this? And for us, I think the real dilemma is and as we look at our portfolio companies as well as our own organization, is it's requiring a more unified approach to solving this issue as well. So, I'm helping to oversee the investment division, and we have 43 use cases, and folks are really wanting to develop this in our due diligence, in our document process, et cetera. But on the other hand, we have to coordinate with our technology folks. Do we have the infrastructure to do this? We have private information on a lot of our stakeholders, so they're huge security issues for us. And so more and more across the organization, we'd have to coordinate with our CEO and our HR division on the resources we're going to need to spend. We spend a lot too, but I'm not sure how much we would compare to Citadel, but it's still a lot. The types of resources we need. So I think we're building this as a unified approach now as we move forward in technological innovations, but it's trying to unify that approach around something that is just moving so quickly.
And people always, especially in engineers, they always want to move forward. They always want the the next thing. But it's part of. I don't know how many people here in the audience have been on the London Underground, and one of the things that can make traveling on the London Underground a challenge today is because the London Underground was so amazing 160 years ago, right? So, tunnels were curved because if you put them in the straight line and the horses saw the light, they'd run off, and all sorts of, it's labyrinthine, you can't put air conditioning in. And to me, it's kind of how we think about it at Citadel. We have to be nimble. Being nimble and liquid is part of our investment strategy, but it has to be part of our technology strategy. We may be, we are a big financial company, but we can choose not to take on that technical debt. So look, whilst you're doing all this new lovely stuff, there's the old stuff, the stuff that your clients are logging on, you rely on for really core processes. Those things you have to make a big decision about whether to keep them running or to move on, but not incurring, moving on from technical debt and not accumulating it in the future is, I think, it's always been a big part of our strategy, and it's something that we think more of when you're just presented with so many ways to spend money in this new world. And one of the things we had to educate some of our more junior people on. So if you think about for us, we have some processes that are very compute heavy. So weather simulations will be very compute heavy. We have some things which are very memory heavy. In my group in risk, we have lots of time series of lots of different things to do our job, so we're kind of memory heavy. If you want to do that on-premise in hard machines, the number of machines you're buying is just going to go up and up and up. So for us, AI is not, at the moment, it's not either heavily used or transformational, but cloud computing was. But we did have to say to somebody, just because you can do something, you can do now 100 more things, 1,000 times more things on the cloud, doesn't mean that you should. So that was one of those areas where we adopted it, but we were very thoughtful about, hey, what we want out of this is we get storage of data, but this is going to be cold because we don't need it all the time. We get more workers online when we want them to do that heavy compute when we need it. And I think having people throughout our organization who have an engineering background, I do too, it definitely helps in that regard.
The tech debt point is a really great point. I mean, the least exciting thing to spend money on is winding down your old systems. We have this debate every year in our operating committee. When you start to accumulate a lot of tech debt, it's really hard to move forward. And just on the AI point, it is early days, and I think I hear this quote all the time that 2 years are going to be underwhelming, and 20 years of AI are going to be overwhelming. I do think we're not going to see a whole lot in the next 2 years that's transformational. But I do think it ties to something Joanna said earlier, which is if you can pull away some of the least enjoyable parts of anybody's job, then you can really create more value. And if I just think of a basic use case right now, a lot of our analysts are using it to analyze a quarterly call. I spoke with one of our analysts who's like, I'm on my 20th year of doing quarterly calls. That takes a lot of my bandwidth. And if you're spending 50, 60% of your time aggregating and summarizing data and not actually looking at the interpretation of that data, then you're spending your time in the wrong way. And so it really has the ability to shift the way you're spending your time in creating value for clients and really getting to the point of that kind of 80-20 rule of what you want to accomplish.
And what's the demographic of all of your businesses? Is it are you bringing in very early career people as the sorts of problems that they're able to work on, or you want them to work on, changing because the investing environment is changing?
Yeah, well, we have very much an apprenticeship model at Teachers, and I think it lends itself well to what we're talking about here in terms of the transformation that needs to occur, because increasingly, those people coming into the organization are going to be teaching the people who are already there. And I already see that dynamic in my own team. We are constantly being instructed by the most junior person in our team about exactly what we should be using ChatGPT for, and ChatGPT 4. I actually think that actually I think gives us a bit of a boost in terms of changing the culture.
Do you sit together?
We
like
all,
in the same room in
yes.
office?
Yes, we do. Very well. And we also make sure they're actually there, as opposed to their jammies at home. Yeah.
And this is one for either Jonathan or Scott or Terry. To what extent have you noticed the sort of march of the multi-strats onto the talent market? Like, we talk often about the talent war, and people like Citadel have got seemingly endless pockets and a pass-through expenses model, which allows them to invest a lot in talent. How has that changed the game for all of you? Because clearly some of you are running sort of public institutions rather than private ones, and so you can't sort of pay what a Citadel portfolio manager might get paid.
I mean, I would say that we're different in the sense that a lot of folks are joining CalSTRS for the mission. They really believe in, number one, serving over 1 million California educators. That's, personally my mission as well. My wife has been a teacher for over 30 years. So that's a big draw. And we tend to, we actually, I think we're sort of counter indicator. During recessions and difficult times, we tend to attract a lot more folks because people are rethinking their careers, like, what should I be doing? And so we're getting a lot of experienced people from Wall Street, from private equity, from all sorts of areas, and that tends to be our largest pool. We have a very high retention rate, so call it 4 or 5% turnover in a year, and so we're very much in an apprentice model as well, where folks do well, and hopefully over time they keep growing at CalSTRS. So we're a little bit, I think, of a different animal in terms of how we recruit and who we recruit for. The folks that I think want to be at a Citadel or really look for the last dollar of earnings, they don't seem to be attracted to CalSTRS in the first place.
We tried to hire their chief risk officer, way too expensive. No, you have to sell them on a different value proposition at Wellington. I think what Citadel does and does extremely well is hedge funds, and we do a lot of different things. And the investors that we tend to attract, I would say at their earlier stage in their career, are looking for different pathways, and we offer a lot of different pathways at the firm. So if you're bringing somebody in that's new and raw talent, they look at the firm and say, well, I could go in a lot of different directions. I could go to the public side, I could go to private equity, I could go to hedge funds. And so you can get a lot of raw talent to plug into a system that has multiple paths for their career to take. And at times you can bring in even lateral or senior talent that wants to plug into the ecosystem at the firm that's quite different than a hedge fund that is going down one lane. So you just have to sell them on an ecosystem that's been built in a different way.
So you had asked about one of the pillars of Ontario Teachers when it was born, and one of them, when I referred to governance, the other aspect of it was to be able to pay reasonably competitive rates of compensation. So really, we were able to attract the folks that would make those execution teams competitive with anyone. And so we've been very focused on making sure that our talent was properly compensated. That is part of the model. What I would also say, though, is that there's an added mission element. So just to pick up on what you were saying, I think people do find themselves motivated by the mission to preserve the retirement security of the teachers who live in Ontario. And I would also say further that there is an attraction among both mid-level and incoming people to do stuff that's pretty darn interesting, quite frankly. I've been at Teachers for over 20 years, and I don't remember being bored once, and that's quite a statement. And I'm sure my colleagues who are in the audience here would agree with me.
And Joanna, who's Citadel competing with then on the talent front? Is it other hedge funds, or is it OpenAI or Tesla or Google for engineers?
I mean, in terms of competition, we compete for talent, but if you in terms of results, we are the number one in terms of results, and over a long period of time. So that in itself is a selling point for us. It is, it's a competitive advantage for us to say, if you're an equity portfolio manager, you walk in the door and it's, here's the tools you need to do your job. Here's what the talent landscape looks like as you're trying to hire an analyst. Look, there is, yes, there are some new multi-strats starting up. Some of them, the launch has been a very big number, and the reality is going to be a smaller number. But in my opinion, that capital raise could turn out, in hindsight, to be the most straightforward part of the process, because you're dealing at that point with just with possibilities, not realities. And here's the reality: you have to hire top-class investment talent, and they have to put capital to work day one. One of the conversations that myself and Ken have a lot, which may surprise some people in this room, is, are we taking enough risk? We need to take, hey, we actually would like some more risk in our portfolio. Are we taking enough? So you're a new hedge fund. You have to hire that talent. You have to, like day one, they're going to walk in, and whether whatever your policy is on them building their equity model or having the analytics in place, everybody professes to be fundamental, analytically driven, process driven. So day one is that data in process, or those systems in process. And is your organization, do you have that strength and depth, or do you have a multi-speed organization where the investment team is running really fast, but how good is your risk management team? How good are your engineers? How good are your data strategies people? All of these people, how good is your operational team? One of the things that's a real point of pride to us, actually, besides besides Ken, the person who's been there probably like 5 days less than Ken is our COO, and for him it's a point of pride that we're a great counterparty. People love dealing with us. Citadel is operationally very robust. They're very well funded. They think like we think. As our counterparty, it's almost like they've thought, what kind of a portfolio would we like to face against? And that's not something that just comes into being day one. I was at a panel this morning on private credit, and they were talking about the opportunities there. And I think it was a number of people said about the chap from Carlisle. That's where the money should go, because these people are built out, and it's a strategy that it has a particular profile that can be pretty hazardous if you go in there without all of the pieces being absolutely top quality.
True.
Just on private equity, moving on from technology and risk management and things, but Scott, CalSTRS has got 15% of its portfolio in private equity. Is the denominator effect still an issue, do you think, or have we moved on from that?
Well, I think we just see it over many cycles, right? So at the moment, yeah, we're a little bit over allocated private equity, and we haven't seen much of any exits in the market. It's starting to unfreeze a little bit, but I think this big freeze is still in existence. So for us though, we look at it across many cycles, and one of the things we recently did was enhance our liquidity tools to weather these. Because if we have 43% of our portfolio now in private markets and alternative assets, we're sort of beholden to that cash flow stream, which can be lumpy over time, right? So in many of these structures, we control them, and many of them we don't as well. We're still in a base of commingled funds. So we need liquidity tools to make sure we can manage those cash flow streams in normal environments. Where, if we thought the recent past was normal, like the last 18, 19, 20 months, we haven't seen many, if any, of our funds really exiting in mass. So that's to manage that component. But one of the areas that we talked about initially was systemic risk, and I think one of the lifeblood of an allocator is always to be able to deploy capital from a long-term basis. And so it's not only to help us manage cash flows from time to time, and we have a very unlevered balance sheet, so that's an advantage. It's also to deploy capital at the worst time, right? When markets are down 30% or plus, and everything is going down in a very correlated fashion, no matter how we've diversified the portfolio. But we know that as a long-term investor, we'll be able to see those investments through over the long term. So we're using liquidity for those two purposes.
And in terms of being sort of greedy when others are fearful, where do you see that dynamic right now?
I think that right now we've decided that we're under-levered. We have a little bit of net cash. We don't think it's a time to be greedy. We're seeing sort of an okay amount of, maybe I'd even say a subpar level of opportunities in many areas. But on the debt side, we're seeing a lot of opportunity because the debt's sitting on top of the equity. And we're finding opportunities to be higher in the cap structure or backed by an asset, with a spread of 5 to 6% over SOFR. It's really a strange market where we need to hit 7% or greater to meet our liability sets to fund the 1 million over 1 million California teachers retirement. And so in many ways, there's a lot of areas to do that in on the debt side, but really worried about the equity side of the equation. And we're fairly cautious. We've probably paced down with the market. That's been anywhere between 40, 58% down in terms of transaction volumes.
Jonathan, what are you seeing in your private equity allocation?
We're pretty happy with the allocation. It's significant. It's larger than CalSTRS. I think that there you have to think through value, and value is created sometimes differently in different states of nature. So no doubt there is a greater focus today on building value in the companies we own, as the overall capital liquidity environment is a little bit less robust than it was before. But I actually think that many of the things we've talked about already today contribute significantly to finding all sorts of avenues of finding value, further value, as part of the asset management process. I just mentioned two. I think we've kind of did the AI thing to death. But it is a very important value creation tool, we think, and one of the key areas where we're putting efforts right now is to contribute to the tools that we offer to the companies that we own to advance their capacity to grow. But I'd also mention the climate change issue. So we are trenchantly focused on investing in the transition. And one of the things that we feel is a very important part of that asset management process is both, not just when you buy the asset that make the assessments about, well, is this going to be a stranded asset or not, but it's also about actually the husbanding of the asset itself. And there are, I can think of at least two examples where we've made investments while being an owner to advance, for example, the circular economy aspect of certain of our assets, so that they resonate with that transition. Because look, this is about gaining the highest exit multiple possible and generating the most cash along the way. And these tools are tools, particularly in a case where you have a significant share, which is often the case for teachers, not always, and sometimes control. You have some tools at your disposal which actually can be highly impactful in terms of creating value. So I think that's maybe a mindset shift also in the PE world. I think that this is not a forever thing, but I think in the meantime, there's a great opportunity for us to focus on that aspect, as well as finding new deals with the liquidity, which we do manage very carefully at Ontario Teachers, so that we can respond, as you said, and pivot to those opportunities as they arise when things change.
We've just got a few minutes left, so I want to, if you're in the audience, it's your last chance to ask any questions. Perhaps to end, I'd like to ask each of you, what's the biggest challenge facing your business model right now?
Citadel. I actually think it's slow growth. I mean, cash has actually been the biggest asset gaining or biggest asset, the asset class that's gained the most share. It's a pretty good Sharpe ratio when you're at 5 or 6% cash. And so when we look out at the market and we see a little bit of de-risking, I think there's the potential to sort of rein in investment in a low-risk environment. And I think what you have to do in a model like ours is to really continue to invest and find scale. And the way we find scale is with big strategic partners, because we do a lot of different things. We can generally solve most solutions and or provide solutions to most problems for them. Two of our bigger strategic partners are up here on the stage. You have to find channels that are growing a little bit faster and potentially at a higher price point. Global wealth has been that avenue for us. And as I've mentioned a few times now, you have to find things that you can add to your investment ecosystem that really bolt onto a chassis or an infrastructure that's already in place. I consider that to be our central research. And by adding on different products that have a higher price point or a diversifying effect, really help us manage to an environment like this.
Well, I think that the unified theme for us is that we talked about this. There's a rise in systemic risk. There's a paradigm shift in terms of the economies, the tailwinds turning headwinds. There's technology innovation. What unifies all of that as a challenge for us is the ability to work as a unified, holistic organization. Right? We talked a little bit about that in thinking about AI and all the components we need to align. The same thing could be said across all these issues as we think about the systemic risk and how we are trying to build a more adaptable, dynamic approach. It's across all of our asset classes coming together. It's building the insights so that we can become more dynamic. It's building the liquidity tools. And so I think all of this is a challenge for us because it's really how do we align the board? How do we align our stakeholders who also are very affected by AI, our teachers, right? So how do we communicate that? Sure. How do we align our staff? And we're part of the investment team, but we deal with the whole back office, middle office with the enterprise. So how do we align them? And that's really the challenge, because the risks that we're seeing, the issues that we're seeing, I think never before have really necessitated this really unified sort of holistic approach to CalSTRS.
I think I would characterize the biggest challenge as a strategic one, which is, by the way, not solely the case for Ontario teachers. I think it's going to be the case and is the case for almost every organization today. The balance you have to find between curling up into a ball and wanting it to go away, which is very tempting but not very successful, versus you can get over the edge of your skis. And I think that finding that balance involves something that a lot of people in finance, I find, are not necessarily that accustomed to, which is you have to get really convicted on something and then be able to climb down if it doesn't work. And so the management consultants call this strategic imperfectionism, which is very consulty, I realize, but nonetheless, it captures, I think, this requirement in terms of leadership to be able to get real excited about things, to get people galvanized around something, and but realize that what we're doing in this uncertain environment, it's not a risky environment, it's an uncertain environment, is that we're like Deng Xiaoping, we are crossing the river feeling the stones. And if you didn't find enough stones, you stop. If you find some, you keep going. So every thesis is an evolving thesis. To me, that's the biggest challenge.
I'd probably say, two things. Scale for us is the first one, and it's something that, thus far we've found an answer to it, but if we continue having great years, we don't want to be seeding the rest of the space with capital because we have to distribute it. So that's something that is continually something that we have to step up to. And I'd say the final thing, and it's great because it's like a minute, so I can just say this and then we can leave, is poorly thought out regulation. I'd say that's the, like for us, this very invasive, very poorly considered suite of regulations that are in process or being considered right now. This is, it's the cost benefit of it is all wrong.
That seems like a good moment to end on. Thank you.
Thank you.
Thank you to Terry, Scott, Jonathan, and Joanna, and thanks to the audience for joining us. And now to Elon Musk.
Thank you for attending the discussion. Please exit the ballroom as we prepare for the next session.